Good morning, everyone. Today it is Happy Friday, January 8th, 2021, and we here at Harvested Financial are looking at the markets. So before I get into everything, as everyone knows, I have some brief disclosures to make, and that is that all of the information, commentary, and opinions expressed here on this or other websites or on any social media platforms or in any media format reflects the personal opinions, viewpoints, and interpretations of the employees making such comments and are not to be considered a description of offer of advisory services by Harvested Financial. The opinions expressed are for general informational purposes only and not intended to provide specific advice or recommendations for any individual on any specific security or investment product. It is only intended to provide education about the financial industry, and in no way is the content on this meant to convey investment advice, performance data, or any specific recommendation to buy or sell securities. Harvested Financial employs multiple methods of analysis and security selection to create our client portfolios, which are not discussed in their entirety here. All investments carry the risk of loss, and users should discuss any decisions with their financial advisor. Past performance is not a guarantee of future results. So now that we all know that, now that we can talk about the markets, well, it is Friday and we are looking at green once again. We are looking at green in SPX. So SPY is up $1.70 today. That's 46 basis points, topping out over 380, another all-time high. We are looking at IWM, 27 basis points. QQQs, 84 basis points. The markets are just going green, continuing to see the trend. We rallied through the end of the year. We're rallying through this first week in the year. Really feels like the drop off earlier this week was but a blip. So while we're thinking about all-time highs, one asset I forgot to mention was Bitcoin, again at all-time highs. We're pushing that 42,000 number. So Harvested Financial is very interested in getting into option strategies here. So we can't wait to begin to offer products like that to our investors. But in the meantime, we've got plenty of interesting things to look at in the markets. And the other one I want to pull up that's also making all-time highs is Tesla. Tesla's trading up around $850 a share right now. Wow, up $32 today. So it's another almost 4%. This is the train that keeps on running. Saw in the news yesterday that Elon Musk has actually surpassed Jeff Bezos as the richest man in the world, thanks to his Tesla holdings. So this train keeps on trucking, pun intended there, I guess. But what do we think about when we are at all-time highs? One of the themes I've been talking about this week has been the zero cost collar. And so those are particularly interesting ways for investors to stay exposed to some potential equity growth, but putting a collar around it. I think one of the really interesting features of this is that you can have a 1% collar, protecting your downside against no loss of greater than 1%, but capping out your upside as a gain of 1%. You can have a 10% collar. So lots of interesting ways to play this collar. And today on Friday, I'm going to look at an even different way to think about that. So let me share my trade hawk and we will get into what's going on with Tesla. So here I am looking at the Tesla options, and I'm actually going to come right up to February. So looking at Feb, it's about 49 days out. Implied vol right now is around 80. So, we talked about the classic collar strategy of simply buying a put to sell a call. Well, we love spreads here at Harvested Financial. And one of the ways you can think about altering this collar is to use a combination of a put spread versus a call. So remember, one of the interesting things about spreads is that they're defined risk. And it means it's also lower capital outlay. So rather than just buying a put and selling a call, if you buy a put spread, you're going to have to sell a much less expensive call to finance that put spread. A put spread is going to be cheaper than the overall than buying a single put. So for example, like I said, we're trading right around 840 right here. I'm gonna think about buying, let's say, the 800 put. So if we buy the 800 put, right now that's trading around $70. If we were to do a regular collar, we'd be buying that for $70, meaning we're protected below 800. And what call can I sell for about $70? Well, it looks like I'd sell the 925-ish. And that would be, about a neutral trade. These markets are actually pretty wide right here, $7 and $6 there. So it's a $13 wide market, but, approximately, down to 800, you're protected and you get all the way up to 925. So a little bit of asymmetry there, which is always interesting in these names that have a lot of call skew. So we talked about that with Apple a little bit earlier, but that means that the calls are particularly bid up. A lot of retail interest in those calls, pushing the price of those up. So you do get a little bit of that interesting asymmetry, meaning about $45 on the downside that you'd risk versus that's $80 that you get on the upside. So that's quite a call skew here. But what can we do to make that even cheaper? So, this owning that 800 put means you are completely protected all the way on the downside should Tesla go down. But what if you don't think it's going to go down all that much? What if you're willing to, kind of cap your protection below a certain degree? So in this case, I'm going to cap that protection by, I just cleared everything here, but I'm going to buy that 800. And imagine if you're only concerned about it going down to 700. So you want that first $100 of protection, but you feel that it might not necessarily go past 700. So we're going to sell the 700 put against that. So as a reminder, sort of what that looks like in a what if, this is just your regular put spread. And we're going to be looking at P&L like this, where you pay about 4,000 to get into the trade, max gain of 6,500. So remember, that's because we're paying about $40, and that max spread value could be about $100. So the max potential gain would be that 6,200 right up here. All depending on what exactly you pay, but your net debit on that put spread is going to be about $40. So the difference here is that now you only need to sell a call that's worth $40. So we can go all the way up. The $40 call is all the way up at 1,060. So for a relatively neutral trade here, you get from 840 all the way up to 1,060. So you have almost a little over $200 of upside. We're trading at 850 right now. You get $210 of upside all the way up to 1060. So you have $200 of upside. That's almost 25% here, and you're protected down to 700. Now it won't protect you below 700. That is the effect of selling that put. But assuming you're generally bullish on this and think there's a little bit of a floor, a really interesting way to play that zero cost collar is instead of buying an outright put and financing that by selling an explicit call, if you buy a put spread, reduce your overall required debit on your protection side by exposing yourself a little bit more, you can actually give yourself significantly more upside. So we have almost 25% upside to gain here, while our downside, we're covered essentially all the way down to 700. So zero cost collars, amazing ways to think about how to handle your stock when you're sitting on all-time highs. Maybe you're sitting on a lot of capital gains. There have been a lot of Tesla bulls. Kudos to them on all the money that they've been making here. But this is a great way to potentially lock in some of your gains while giving yourself still some of that upside that you might want to protect yourself against a little bit of a near shock, but you do have all that room to run. So lots of different fun ways you can play with this. Obviously, that put spread can move around to all different places. Perhaps you want to protect or to have a little bit more of a downside in exchange for a further out of money, cheaper put spread. Well, that could even give you more room on the upside. So zero cost collars, option strategies that make a great way to protect your capital. As we've talked about before, this also makes a lot of sense if you are getting this type of equity-based compensation. So whether it's RSUs, GSUs, or any type of stock-based compensation, putting a zero cost collar around that allows you to lock in the value of your bonus and not necessarily subject that to either specific company or overall market risk. So plenty of fun things to do with zero cost collars, and that's what we love doing here at Harvested Financial, is developing these option strategies that fit your personal needs and risk tolerances. So thank you for joining us. It is Expiration Friday. We're going to be trading a little bit today. We're going to be looking at the markets, and we're just going to be watching what's going on because that's what we love. Options and derivatives are for everyone. So check us out on Twitter at harvested_DAFE because derivatives are for everyone. And also make sure you hit subscribe because we're putting out new content every single day. And like I mentioned earlier this week, next week, we're going to have tons of new stuff coming out. So not only are we going to have the daily bread, we're also going to have an analysis of our indicators. We're also going to be doing a roundup of news items, and we're going to be reviewing the closing markets. So there is tons of new stuff coming. Make sure you subscribe and follow along because we are here to bring a little bit of different. Thanks again. Happy Friday.